SIPI versus lump sum. Which one wins? Imagine you have 6 lakh rupees to invest. Should you invest the entire amount today? Or should you invest it gradually through a systematic investment plan, also known as SIP? This is one of the most common questions every investor asks. Some people believe investing all your money at once generates higher returns. Others believe SIP is the safest and smartest approach. So, who's right? In today's video, we'll compare SIP and lump sum investing using real-world logic, practical examples, and different market conditions. By the end of this video, you'll know which strategy is more suitable for your financial goals. 2 different ways to invest. Let's start with the basics. A lump sum investment means you invest your entire amount in one go. For example, if you've received a bonus, sold a property, or inherited money, you might choose to invest the entire amount immediately. A systematic investment plan, SIP, works differently. Instead of investing a large amount all at once, you invest a fixed amount regularly, such as 5,000 rupees or 10,000 rupees every month. Over time, these regular investments help you build wealth while reducing the pressure of timing the market. Both methods aim to grow your money. The difference lies in how and when you invest. Timing the market versus time in the market. The biggest difference between SIP and lump sum is market timing. When you invest a lump sum, your returns depend heavily on the market level at that exact moment. If the market rises after your investment, that's great. But if the market falls significantly, your portfolio may remain in the red for months or even longer. With SIP, you don't need to worry as much about finding the perfect time to invest. Because you're investing regularly, you automatically buy more units when prices are low and fewer units when prices are high. This is known as rupee cost averaging, and it helps reduce the impact of short-term market volatility. That's one of the biggest reasons SIP has become so popular among long-term investors. A practical example. Let's make this simple with an example. Imagine 2 friends, Rahul and Aman, each have 6 lakh rupees to invest. Rahul invests the entire 6 lakh rupees into an equity mutual fund today. Aman decides to invest the same 6 lakh rupees through a monthly SIP of 50,000 rupees over the next 12 months. Now imagine the market falls by 15% during the first 6 months and then gradually recovers. Rahul's portfolio immediately drops in value. Watching a large investment decline can be stressful, and many investors panic and sell at the wrong time. Aman, however, continues investing every month. As prices fall, his SIP buys more mutual fund units. When the market begins to recover, those additional units benefit from the rebound. This example shows why SIP can help investors stay disciplined during market volatility. When lump sum wins script. Does that mean SIP is always the better choice? Not necessarily. If markets are at reasonable valuations and continue to rise steadily over the long term, a lump sum investment often generates higher returns because your entire money starts working from day one. Instead of waiting to invest gradually, every rupee is invested immediately and has more time to compound. That's why investors who receive a large amount of money, such as a bonus, inheritance, or proceeds from selling a property, may consider a lump sum investment, provided it matches their financial plan and risk tolerance. The key point is this: lump sum investing can be powerful, but it also carries greater short-term timing risk. Why SIP works for most people? For most people, SIP is the more practical approach. Why? Because most of us earn a monthly salary, not a large lump sum every year. SIP turns investing into a habit instead of a one-time decision. It removes the pressure of trying to predict the perfect time to enter the market. More importantly, it helps you stay consistent, and consistency is one of the biggest drivers of long-term wealth creation. Successful investing isn't about making one perfect investment. It's about making good investment decisions consistently over many years, and that's exactly where SIP shines.
Mistakes to avoid. Before you decide between SIP and lump sum, let's talk about the mistakes that hurt investors the most. The first mistake is trying to time the market. No one, not even experienced investors, can consistently predict the market's next move. The second mistake is stopping your SIP when the market falls. Ironically, Market corrections are when your SIP buys more units, which can benefit you when markets recover. The third mistake is investing without a clear financial goal. Whether you're saving for a home, your child's education, or retirement, your investment strategy should match your timeline and risk tolerance. Remember, investing is not about reacting to headlines. It's about following a disciplined plan. The right choice depends on you. So, which strategy should you choose? Choose SIP if you invest from your monthly salary. You're a beginner. You want to reduce market timing risk. You prefer a disciplined and consistent approach. Choose lump sum if you already have a large amount available to invest. Your financial plan supports long-term investing. You're comfortable with short-term market fluctuations. And here's something many investors overlook. You don't always have to choose one over the other. If you receive a bonus or any unexpected cash, you can invest part of it as a lump sum while continuing your monthly SIP. This balanced approach helps you stay invested while maintaining discipline. Consistency beats perfection. At the end of the day, successful investing isn't about finding the perfect strategy. It's about choosing a strategy you can follow consistently. Both SIP and lump sum can create wealth when used in the right situation. The real secret isn't timing the market. It's staying invested for the long term. Because in investing, time is often more powerful than timing. If this video helped you understand the difference between SIP and lump sum, hit the like button, subscribe to Investor Syndicate, and turn on notifications for more practical investing insights. Thank you for watching, and I'll see you in the next video.